All right, well, let's kick off the midway through the third quarter investment committee meeting, August 12th. We have Glenn Wiggle, Jason and Alexis from Alexis Investment Partners, and Drew Miller and Mike Zimmer. Myself, Dan Neiman, Chief Investment Officer. I think let's start with Glenn. A little political update, Glenn. How are we doing on the political front, and how's that affecting the markets?
We're doing good. We're doing good. The markets are just hit all-time highs today. I just saw that the S&P and NASDAQ notched all-time highs. So things are good. I mean, obviously the prices are a bit higher. You saw the consumer price index come in a little bit higher, but it doesn't seem to be affecting demand too much. So you're seeing a massive amount of investments in the U.S. I think that's part of what's missing in the conversation in the media about these trade deals. It's not so much the amount of the tariffs, the 15, 20, whatever. It's the amount of investment he's getting in the United States, whether it's Apple's $600 billion investment back here, or it's the European Union buying our liquefied natural gas and energy products, or so on and so forth. So he's really doing a good job, I think, in bringing that manufacturing home, and I think that will play out very well in the long term. In the short term, you're seeing prices higher, but honestly, when I hear the media, it seems like things are a bit backwards. To me, if prices are higher, that should push demand down a bit. Demand comes down a bit, that should help to ease inflation. To me, they've got the chicken and the egg wrong as far as inflation versus higher prices. To me, the money supply and the amount of demand is what drives the prices. It's not the prices that necessarily drive inflation, right? It's inflation that drive the prices. So I think to understand that, you look at the whole landscape, and to me, net things are super positive. So what I'm seeing in the market from a market standpoint, and that's not the question, but I am seeing some stocks that have been previous leaders start to show some signs of weakness. A few have broken down below their 50-day moving averages, and that's a bit concerning. I think we may be heading towards a minor pullback. I don't know why. I don't know what the cause is, but I'm just what I'm seeing in the stock portfolios and what's kind of forcing us to raise some cash in a way. But I think long term, the things are positive. So on the geopolitical front, Trump seems to be signing peace deals all over the world. I mean, it's really quite amazing. It's too bad he's not getting credit for it, but he's ending 20, 30-year conflicts in places I've never even thought of. So this is all positive, I think, for America, and I think positive for the world. So it's just too bad, again, that we have Trump derangement syndrome seemingly running rampant on the left. I mean, he comes down and announces that he's going to try to lower crime rates in D.C., and their response is to come out at 8 o'clock at night and bang pots and pans. Meanwhile, while they're doing this, which is not sane behavior by any rational standards, somebody was literally shot a block down the street. So I don't know. I mean, I don't. At some point, I hope that reality begins to set in. I am seeing the media in some cases actually admit the truth. I did see an ABC News anchor say, "Hey, my coworker this morning got her car stolen. I was mugged a year ago, and there was 2 murders in the last 6 months that were shootings down the street." So, there's that, I guess. But I think he's winning, and I think as a result, America's winning.
Thanks. Let's go to Jason. Jason, you want to give us a little bit more on the economic update and sort of from the interest rate environment, like Glenn mentioned, consumer price index numbers came out, earnings. Give us a take on what you think is going on and what you think is going to happen as we push towards the end of the year.
Yeah, I mean, I think we've been doing a little bit of backing and filling this month, and so we're how do I put this best? We kind of hit 3,400 or 6,400, and we think we're heading up towards 6,700 is sort of our range here. Whether we grind straight up or whether we peel back a little bit and have to do more backing and filling, is a challenge. We're heading into Jackson Hole. That's still about a week and a half away. It just, for whatever reason, invites a little bit of volatility that week. And so it'll be interesting to see, how that plays out almost regardless of what kind of messaging comes out of that, if that makes any sense. So I think that's, one area to kind of keep an eye on. But I do think that, you're still dealing with the fact that a lot of people, have been underinvested. They made mistakes, as they often do back in April. and they're chasing their way back in. And by the time they get in, they're probably going to get beat up again. And, and we'll go from there. I think big picture, one of the things that has us, as much as we turned more defensive, if you our letter, if you've looked at our holdings, but we've scaled back our equity exposure in Lexi from, we got up to almost 90%, 85+% equities back in April. We're down to 65% stocks now, and we've sold some covered calls against some of our stocks as well, a small percentage of that. So, this is, we're definitely a little below neutral, lots of firepower to buy in, but we're up more than 10% year to date. And so for us, it's just prudent risk management coming into a seasonally weak period, just to give ourselves what I would call optionality. We want to have the ability to buy into a dip if one materializes. We doubt it would be a top. We really do think it would be a situation that we would want to buy. And that's why we don't think it's going to probably be all that severe. I think there's, still the $7 trillion on the sidelines. There's still a healthy amount of skepticism out there. It is politically divided, but, as we all know, people tend to capitulate on those concerns when they see everybody else making money and they're sitting on the sidelines. After a while, they get tired of fighting it. And I think that's kind of the phase that we're in now. That does become a little dangerous with valuations high, as it's hard to argue that they're not. We still think where the rubber hits the road is somewhere 3 to 6 months, maybe a year from now. We need to either see a productivity miracle, right? We either need to justify valuations because, people coming back to work, all this investment, whatever else starts to really pay off, and we see an acceleration in earnings growth. Or at some point, there will be a catalyst, as Glenn kind of alluded to. We don't even need to know what the catalyst is to start to push valuations to more normal levels. There's plenty of companies out there, as we all, Dan, you could speak to this better than any of us probably, plenty of good companies that you can find that have been more boring, that are starting to do well. People are paying attention to that. Diversification is not hurting you anymore. That's the great news. I mean, owning some foreign is still doing fine. Everything's kind of moving in fits and starts. You're still very much getting rewarded, however, for being in big tech, and there's nothing wrong with that. That's where a lot of the investment dollars are. And you're still, being paid to be invested. But, at some point, the higher we pay for things, just because people are, finding that equities are still the best place to put their money, at some point that tide turns. We don't think we're there yet. We still characterize the current market environment. Our best, historical reference is still 1998. As we all know, 1998, if you ran away from the market when it was up 10%, you missed another 15. And then 1999 was, again, a little volatile at times, but a pretty solid year. Again, it was followed by, though, a pretty challenging window of time. And we still think the only way to escape that is going to be a productivity miracle that so far throughout history has been elusive. So that's my good news, bad news message. It's kind of a make rain or make hay while the sun is shining. We do want to be participating. We don't feel the need to participate as much. So we're grateful that we've gotten it up to now. We still think this is the time for diversification. At the same time, what we're interested in is how long you can get away with just, being invested and rebalancing versus having to have more of a trading mindset. We think we're getting closer and closer to that kind of an environment for whatever that's worth. In terms of interest rates specifically, there's not a lot of stress in the market right now, right, is the way I would describe it. And I do think the Fed cutting rates, if they do it, and that's a big if still, I think they will. I think by doing that, they're going to set the stage for us to finally, 6 months from now, be back in the mode we haven't been in since the late 90s, which is a market-driven interest rate environment. Ironically, I think that means that most of your market-based rates probably drift a little bit higher because you kind of lose that feeling that the Fed's going to push us into a recession. And so I think that's going to allow the 10-year to cruise back up towards 5%, as we've talked about. Inflation still seems stickier in the 2.5% to 3% range. 5% is reasonable for 10-year. Mortgages stay in the 6% to 8% range. Corporate debt probably right around 6 or 7%. But you can get adjustable rate mortgages then, in the 4s and 5s. And maybe, just maybe, if you start getting 3% on your money market instead of 4.5%, which is artificially being held high, some of that $7 trillion will start to move into other assets. And that'll be interesting to see how it all plays out. We'll get through it. I think there is a lot of, good things happening and so forth. And for now, again, we'd rather be in than out, just with, again, some optionality to allow to get through some volatility. The business is doing well, by the way. I'm sure it's doing well for you guys also, but I think people are still engaging and they're happy. We go out and about, we're seeing plenty of activity. So again, not a lot of reasons for our perspective to be sitting on the sidelines. Hope that helps.
Yeah, no, thank you. I agree with you. And I think volatility creates opportunity, right? So we, as stock managers or as asset allocation portfolio managers, right, inside of Independent Solutions and, inside of our PT models, like every month you're looking at, where the trends are going, right? Where can I invest our money in equities, fixed income, international stocks? And I think all of the volatility helps us that are actively managing portfolios. I agree with you that I think there should be some sort of, from where we were in March and April, and then as we kind of got out of that in May, June, July, and now we're into August, is there going to be some sort of caveat that pushes the market back down? Or are we going to continue this upward trend? We don't know. So we have to be active and participating when things are volatile, right? Not a lot of changes when things are going smoothly. And I think on the note of, talking about interest rates, and there's not a lot of reason for them to do anything right now. I think there's not a lot of triggers that should lower rates or things that are going to make the markets sort of overreact. Not that can't happen tomorrow. So I think status quo is good right now. But I wanted to reach out. Alexis, is there anything, your dad missed? Anything you guys have been talking about? Anything you guys have been researching that you think would be something our investors in our PT models would want to hear about?
No, I don't think there's anything that's been missed.
Speak up.
Oh, sorry. No, I don't think there's anything that's been missed necessarily. The one thing that I'll say is, I know you said there's not a lot of catalysts to make the Federal Reserve lower interest rates, but I do think that they are due to lower interest rates, but not because of anything new going on per se, but just because it's something that we've been calling that they would be doing around this time for a while now. And since it's the status quo, it would really make sense for them to kind of take that chokehold pressure off of there. Even just looking at their own projections, the Federal Reserve is still holding interest rates higher than they need to be neutral. And since given all the economic data coming out right now, there's just no reason to do that.
I will throw one catalyst into the mix just because it's been bizarre for us to observe in some client conversations. A lot of people have been deferring their student loan payments, and that bill is about to come due. I think it's in November for all those people that have been kind of not paying their student loans for, in some cases, since COVID. And we've seen balances that have just shot up. I don't think people really recognize the interest continued to accrue while they weren't making those payments. And so, for some people, I think they're in for some shocks, and that may cause some stress in other areas. I think it's one of those known knowns that everybody's kind of choosing to ignore, but it may be an interesting, sort of sidebar that could create some stress in areas where people are, kind of have gotten more comfortable stretching in order to allow things to kind of continue to move along. So I think there's going to have to probably be some release valves here and there and whatever else. I I don't think the Fed's going to want to get blamed for everything. So I think they're going to act. I don't know that that's going to be forceful, but I think that's probably going to be a piece of it. But I could probably come up with, and I'm sure each one of us, if we're asked, could come up with 2 or 3 catalysts that could push the market down. The real issue is, does anybody care anymore? I think there is still money on the sidelines. There has been so many little bouts with volatility that we've all faced over the last little window of time. And, you see these stocks that are not just doing well, but doing really, really well, and so forth. So usually that kind of performance chasing doesn't end until, there's something new that happens, and it's hard to picture what that's going to look like. Hope that helps.
Yeah, it does. Let's move on to Mike Zimmer.
Yeah.
What are you seeing? I know, between on the trade side, right? You've got assets flowing in and out of independent solutions pretty much daily.
Mhm.
And, what have you seen, on our asset allocation models, what we're working with as far as whether it be mutual funds or ETFs or sort of the flow of assets into different models kind of usually gives us a little prediction of whether we're overbought or oversold as folks go into, the high flying tech models or growth models with lower risk scores. And then the opposite happens, of course, when the market's down, right? So what have you been seeing in the back end of independent solutions and inside of our models?
Yeah, a lot of what Jason is saying. People are afraid of sitting on the sidelines at this point. People are looking for a bit more risk and willing to kind of go to those riskier models for the potential gains on there. All cap portfolio has been performing really well throughout the year. It is a model that, has a little bit of swings in there, especially when we get some volatility going on. But people aren't afraid of that right now. We're kind of seeing a huge block of different accounts that typically would not go to that risky of a level that are now, asking about potentially putting a portion of their allocations to those models to kind of take advantage of what we've been seeing in this market. So yeah, it just seems like anytime we even get a little bit of bad news lately, might give us a small blip for a day or two. And then, 2 days later, we're up and past where we were down from whatever that blip was. So seems like, people are pretty comfortable with where the markets are going, maybe a little too comfortable. But we're definitely seeing a bit of extra risk being taken across the board to kind of capture some of these returns. And then talking about the Fed market, I know futures don't always tell the story, but the futures right now are betting pretty heavily that there's going to be a reduction in rates in September, more heavier than it's been in a long time. I'm looking at about 95% reduction right now. So again, doesn't necessarily mean anything, but it seems to be that's where the market's kind of thinking that they're going to go to.
They lower rates, Jason, you think the market takes off?
If it was me and I was at the Fed, I'd drop them 50 basis points, let people know that it's going to be a short cycle to get back to neutral. And in that way, people wouldn't think that it's going to be, if you go 25, then the next thing is going to be, how long are they going to be doing this for? And everybody's going to start to project that we're in this easing cycle that's going to extend out. And I think if that happens, markets probably do go up because, you've got the whole Fed's got your back thing. I think if they were to act more forcefully, ironically, I think it would be the healthiest thing for markets because it would be consistent with really being able to hold rates higher for longer. But the market could go either way in that situation because you'd have less of that feeling that the Fed's got your back and more of that feeling of, now the Fed's done its thing and the economy hopefully can hold its own, and you'll have all the arguments that happen about, have they waited too long, and whether, are they going to have firepower for the next, all the nonsense that we'll have to work through in that regard. So again, we'll see how that plays. I happen to think what they will do is the 0.25% because it's the easy thing to do. And ironically, that could then set the stage for, again, bigger challenges down the road. I think the thing you don't want to have happen is for, there to be this sort of sense that you can chase, the whole misallocation of capital piece. And a lot of that tends to come from this feeling of either the Fed's got your back or, you're not going to be able to lose money or whatever else, which ironically adds to inflationary pressures and whatever else. So again, if it's me, the message would be simple. We're ready to move towards neutral. We're going to get there pretty quickly. It's not going to be a huge move. Expect it to happen over the course of a few meetings. And in fact, we're going to go 50 basis points this time and see if that is neutral. If not, we may move one or two more times, but don't consider this an easing cycle. Economy's still in a good place. We're just, ready to let the market take over. And I think if they do that, that would be, interesting to see how it plays out. And I'm really honestly not sure what the market reaction would be, but my personal reaction would be whatever it is, that's where you actually want to buy into, because I think, you can get some really great signals then from the market, which otherwise is just hard to do. It's just too much manipulation.
Do you think that actually helps the yield curve that we talked about numerous meetings, the past probably 6 months to a year, we've talked about the yield curve. And I know John, who's not here, would probably want to talk about that, right? So, do you think that helps actually like steepen the curve a little bit? Because I mean, you look right now, it's, you can get 4% plus in a money market. So why would you go any further?
Right. Yeah. So I mean, there's two sides to that, right? One is with $7 trillion in money market assets and still a limited amount of fixed income out there to buy. As yields come down, any money that doesn't go into the stock market or maybe go into Bitcoin or other places, some of that money is going to go into bonds, and that's going to continue to initially keep downward pressure on interest rates. The other side to that, however, is you probably will start to see more issuance of debt and rolling over debt and things of that nature. So I think, it's going to be a process. But yeah, my best guess is that we're 6 months away from a normal yield curve. The low end of that yield curve's probably got a mid-3 number on it, and that's the Fed funds rate and the 90-day Treasury bill when they're done easing. I don't think it's going to be that they're going to drop rates down to 2%. I think they're going to drop rates down to 3.5. I think as they do that, you'll see the yield curve normalize. But like I said, I don't think it's going to be in a straight line. I think ironically, initially, you may see rates get pushed down. But again, what I think you'll see happen is that will prompt some businesses that need to refinance to get out there and start doing that, and some more activity. And that will naturally push market rates back up to more normal levels that are consistent with where inflation is. And again, we look out 6 to 9 months from now, that will really create a wonderful environment in a way that we haven't seen in 20 years, which is one where you can now look at what's going on with interest rates and get a really clear sense of where the stresses are in the economy and where the opportunities are. And all the signals that we learned about in college will actually start to mean something again. So I think it's a healthy environment once we get there. I think it's an interesting transition between here and there. And if the Fed doesn't ease, then all we can really count on is that we're going to stay on this roller coaster we've been on for the last 20 years, which is they'll hold rates too high for too long. At some point here, we'll end up in a recession. They'll have to chase that recession. They'll push rates way back down, and it's manipulation all over again, all over the place. But I think we're moving in the right direction, and I think one of the big moves that'll happen there will be replacing the Fed chair, and I'm really curious to see how that one goes.
Hot topic in the news that I don't want to talk about. But, Drew, I know Zimmer touched on a lot of folks are moving assets into our growthier models. Have you been able to, you're working with the reps, and their clients, especially on the high net worth side. What are you saying to those reps to heed them to stay within risk tolerances? I know we get these, 50 risk tolerance, but the client wants an all cap model.
Yep.
What are we doing on our side to keep expectations realistic, knowing that all it's going to take is 1 or 2 caveats, like we talked about, their potential out there that drives the market down, and these folks are buying at the top, right? Glenn mentioned that we hit another record day, right? Or hit the top of the market again, right? It seems to happen every other day or so. So are we able to teach and I guess allow the reps, the clients to trust what we do, versus them chasing what they think they should be in based on their risk?
Yeah, and before I answer that, I do want to say that I agree. I don't think the reset's going to be market related at all. I think that we're being, kind of led down the path here, especially now that we have, the National Guard being deployed in Washington D.C. I think what's going to potentially start something is the arrests that will occur after when the National Guard steps in, and the arrests of some of these high profile people that are going to be charged very soon. In short order, my opinion. And I think that could potentially cause some sort of massive volatility event. But anyway, I just want to put that on the call here. So in the coming months, we can replay that and see if that comes to pass. But I would say, with respect to your question about the educating of the clients, absolutely. I mean, I think the firm has done a great job with the advisors, and they understand the story. Now that we have Jason and Alexis, and every single month, not only am I sending out information on our legacy models, but obviously on the practical tactical models and Jason and Alexis newsletter. So they are getting that education every single month as well. It really helps. Jason talked about it earlier on the call about the equity ranges inside of the different PT models, and the advisors seeing that there is, changes there, and when it makes sense to be, more closer to the high end of the range for the model. And so every single month that those ranges are coming out, I'm having multiple conversations with advisors about, okay, how is, PT80 position versus PT65 and 100 and down the line. And so that's really been a good place to start on, how that portion of the allocation is allocated and what it's designed to do. And then that kind of leads into your question about, mixing and matching a lot of these models, because we're seeing a lot of people come to the table to say, hey, all cap looks great. I want to put everything there, but we can't do that. And so what I'm able to do is kind of, as we talked about before, is just, run some illustrations with some of these blends, and really focusing in on, where appropriate, as our equity models and Jason's and Alexis PT models, because those really pair up nicely, and it's a really easy story to tell, to have both sides of a strategic and tactical methodology to help the clients going forward. And so it's all been very well received, and again, the advisors, they've bought into it as well. But yeah, we are definitely seeing a lot of people wanting to see the more aggressive models inside of the allocation. So just like we were working on that one today, Dan, we had the client scored a 52, and we were able to get them some exposure on that, more aggressive equity side at more of like a 58. So I mean, it's close in range, and they've been responsive to that. But I do think that it's a really easy conversation for me, because I've just got so much in the arsenal to talk with these people about. So it makes it really easy. But I do think that something's going to happen. It's something is going to happen here, in the next several months, that to derail this. I don't think it'll continue to go smoothly. And it, even if that's self-created, by the media or whoever, because I think they're going to try to do whatever they can to derail, the success that we're having. Because I mean, you hear it every single day.
Do the files come out? Is that what happens?
I mean, I think you got that out there. I think the bigger thing is what's going to happen with these indictments that come down, for, Russiagate and, all of the things that happen. And then I think eventually, once they start declassifying what happened in 2020, that's going to be even more. I mean, like the stuff today that just came out about, Schiff and leaking the documents and all of that. I mean, it's just what I think is happening is that they are slow walking this so that people can be prepared for when they really come in and they take these people down. Because I think that, I tell my friends this all the time, when you shoot at the king, you better hit him, and they missed. And so I think that it's going to be, for the rest of his presidency, the one thing that he will absolutely do is bring down as many people as he can, that went after him. Because what is he going to do if he doesn't? I think Glenn and I, we talked about this before. They're going to go after his family. They're going to go after Barron. They're going to go after Don Jr. So he's going to have to do what he can. But anyway, I'm not the political guy. Let me get off my soapbox here. But those are some opinions.
I don't think it's the arrest that caused.
I got you, Drew. I threw it out there. You chummed the bait.
I don't think it's the arrests that caused the market volatility. I think it's going to be the reaction the summer of love type rioting in the streets, which I think this time will be met with force and a lot of arrests, which I'm really looking forward to, honestly. Any weakness to us to Dave and I is a buying opportunity here. I do think you're going to see the productivity gains. I'm seeing them in our own business, in our own office. I mean, Open AI and whatever Jump AI or whatever these things are called, they're taking notes in meetings. I mean, I just talked to Russ Geiser. He's saving 7 to 10 hours a week. It just not having to transpose, client notes and upload them in the, Wealth Box. Soon, these agents are going to be out there, what they're calling agents, which I'm super excited for. So the AI ability to say, hey, whatever on my phone, make it my doctor appointment with my primary doctor for my annual physical. And then, that AI should be able to go out there and talk to the doctor's AI, figure out what my schedule is free, when their appointment schedule is free, and get that all booked without me ever having to do anything else. To me, that's all coming to mainstream. And I don't see how that doesn't create incredible productivity and just, super performance in people, which I think translates to business, which translates to earnings. So I don't think it's going to be a straight line, of course, but again, I'm super excited and super optimistic. And to us, it's definitely a buying opportunity.
You might be at a doctor in Turkey, Glenn. You gotta watch out.
What's that?
You might be at a doctor in Turkey, but you get that appointment.
Whatever. Hey, you know what? There's going to be bumps. Listen, a year ago, AI couldn't draw a hand. They were putting on 6, 7, 8 figures. Now, AI on my own phone can have a totally perfect video. I created a video in 4 seconds earlier of Trump in a Superman costume flying across the front of the White House. Honest to God. And it was like perfect. Forget about the fingers. Like this was like, wow, there he goes. Look at that.
And you got to make sure you send it to us, please.
Yes.
I'm gonna give you two my last 2 comments. You guys can talk as much as you want. All right, 1998 to 1999, exactly what you're talking about, right? All the conversation about the internet and productivity, right? Absolutely came to fruition, right? Everything we do in our business and so forth could not have happened before all of that stuff took place. And the big opportunity, however, was not in the tech companies or any of the businesses that were the creators of the commodity that became the internet. It was all about the other businesses out there that were able to use this technology and unlock huge value. That was where the investment opportunity was. And if you stayed invested in Microsoft, Apple, and all of the other names that went out of business and so forth, you had a horrible return for 10 years when you could have had, a bumpy ride, but pretty fantastic results in a whole slew of other areas. That's the transition that I do think you want to be incredibly alert to, because it's so hard to do when the story stays the same and it's coming to full fruition right at the time that you do not want to own it, right? You want to own everything else. Second thing I will say is just a reminder to Drew's point earlier, we all are been around long enough to know that when everything feels really good and so forth, there's something bad that's going to happen that's going to derail and whatever else. And when valuations are high, it leads to long-term returns and whatever else. We also, if we remember back to, again, 1998, all the people that got it right in 2000 through the next several years were all early and were all really, really, really wrong to the point that it hurt them in the late 90s, because they were fighting an upward moving tape with a lot of momentum that people were piling into. And they were diversifying early and getting into things that just weren't performing, that people didn't care for anymore and whatever else. That to me is the hardest part about what I expect the market to look like over the next 12 to 24 months. It's basically riding this wave that if you get off it too early, you're going to lose clients, you're going to lose their faith, even, and whatever else, and you're going to lose tremendous opportunity, while at the same time making the adjustments and the adaptations that you need to do, and continuing to educate people when the credibility of the message becomes challenged by what they see. So just a few things to float out there as my 2 cents on why I think it's going to take longer than we all think for the bad things to happen. I just think it's going to grind its way higher as it typically does towards the end of these cycles, and why I think it's incredibly the biggest opportunity we have is to both embrace the technology wave, the innovation, all these things that are happening, but do it in a way that may not seem consistent with what our recent experience has been. And I think if we do that, we've got tremendous opportunity in the years ahead from an investment perspective, from an economic perspective. And I'd love to see these arrests you're talking about. I really would. I hate Adam Schiff. I mean, please punish that guy. But
They're coming. They're
I mean,
coming.
they went after him for the exact same things they were guilty of. I think they have to be tried and brought to justice. But the one thing that I think differs into 1998 till today is that you had a very accommodative Fed that was fanning the flames of a total hoax, which was Y2K, right? I remember 99 being at Paine Webber. The NASDAQ went up like 100%, literally in that year. It was like somewhere between 80 to 100%. It was ridiculous, to a point where every single industry was buying so much technology, routers and blah, 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 because they were so worried about, oh my God, on January 1, it's going to tick back to 1900. It was the dumbest thing I've ever heard in my life. Honest to God, up until that point, that was the biggest scam I've heard in my lifetime. And of course, we went on to the climate, the whole, climate change thing. But I think that was a big part of it. I don't see that here. I don't see companies. First of all, we don't have an accommodative Fed. Let's be honest. We have a guy suffering from TDS, right? If it wasn't for Trump in office, he'd already cut rates in the June meeting. Let's be honest, right? So you don't have that. You don't have that same, and you don't have this scare either. I think companies are buying and investing in technology not out of panic. They're doing it in a very systematic way where they think it is going to help improve certain aspects of their business. I think in 99 they were buying it in panic. I think they were like, Cisco, I don't care what I have to pay. Give me the new router. We have to have our ATMs working. It was the dumbest thing I've ever seen. I don't feel that here. I think it's a little bit more organized. You know what I mean? It's a little bit more of an organized run as opposed to the chaotic stupidity of the 90s. But maybe we're just not at that stupidity level yet. Maybe to your point, Jason.
When you get a chance, just take a look at the number of unprofitable businesses that are out there that are doing well. Look back at 1998, 1999. Look how poorly small caps did, for example. Look just how concentrated the market got. Kind of try to compare that a little bit to today. And I would say the other piece of it is, look at the ability right now, or the opportunity to raise money in a business where your business model is all about leading technology and has nothing to do with generating profits. And just how quickly you can raise money and how much capital chases it. And again, when it comes to monetary conditions, we don't have a super accommodative Fed, but we do have ultra low interest rates and a ridiculous amount of money that was generated through the whole COVID thing that really hasn't worked its way through the system. So I think monetary conditions are pretty much every bit as loose. So it'd be interesting. I mean, I'm curious to see how it all maps out. This has been my roadmap for the last 3 years. And, part of it is based on just your normal 17-year conjorative cycles and all the other things that have driven my investment philosophy for 30 years. But so I'm biased. I admit that. But we'll see how it all maps out. I think that people, you look at REITs and where yields are there, because if it's data center related or whatever else, again, just there's a lot of money chasing after concepts, and some of them are starting to show holes.
Oh yeah. Okay.
And so we'll see how it maps out. I think there is huge opportunity, and I think it's the level of innovation's unbelievable. And forget about just the AI stuff. Look what's going on from our health perspective and such. I mean, it's incredible. But there's a huge amount of money also that's just kind of chasing anything that goes up.
Yeah. I'm excited for my robot and my flying car. I just want to live long enough for both those things.
Yeah,
Next year I'm going to be flying to work. To be perfect.
awesome. Awesome. All right, great. Thanks, guys.
Yeah, good to see everybody. Take care.